let's understand the context, right, of what is hedge accounting. But before that, let us understand the broad accounting treatment of any derivative that we do. So what are the various financial instruments that we have, or rather, what are the various financial risks that we have, right? So from FX and rates, what are the risks we have? One, so we have FX risk, right, on payable and receivable. This is basically, I'm talking about revenue and payable. This is the rate items. Within this, we have two scenarios. One, these payable receivable items recorded, or rather I would say firm commitment, which are recognized. Meaning we already know, for example, you already have raised the invoice, so you already have a payable or a receivable, right? So we know that. Cash flow is basically to be due. Cash flow is due, but it is already there. Then you have unrecorded, right? What do you mean by unrecorded? Forecasts, basically, right? Long-term orders, for example, you're yet to recognize them in your revenue, but you know that this is going to happen, right? So typically, these are the two kind of risks we have. Then second, forex loans. I would say loans, right? Now within loans, you have foreign currency and you have local currency. Now foreign currency, you have FX risk, right? And sometimes, and mostly, we also have interest rate risk, meaning SOFR, Euribor, and so on. In local currency, mostly you will have fixed rate loans. You also, again, I should not be classifying it as a loan, but I don't want to write into separate category. I'll also say bonds, right? Investments, sort of fixed rate bond issuances like NCDs, right? And so on. So again, in bonds, typically it is a fixed rate. So fixed rate means you have the bond price movement. So MTM fluctuations. So these are the typical FX and interest rate risks that you carry, right, as a company. Now, the idea therefore is, in each of these categories, again, within all this, right, so these tend to be short term, these tend to be long term, unrecognized, generally, right, long term, and loans generally tend to be long term. Okay, so multiple short term, long term, then interest rate risk, FX risk, then unrecognized, recognized. So there are multiple FX and interest rate risks that you carry as a business, right? So let us understand each of them in a sort of a broad, but to give a broad perspective on how do you look at the hedging of each of them, right?